Trading Market Technicals Morning Call video for Wednesday, October 23rd. Another big push in the markets due to the non-farm payrolls. Market participants digested the number and thought that it was a little bit worse than expected. I beg to differ. I thought it was a little bit better than expected, and that pumped in continued risk on that the Fed will accommodate the markets well into at least the March or the June 2014 meeting. Dow up 75, Nasdaq up 9.5, S&P up 10, Russell up 315. This is really something that I would really recommend not putting in any additional longs in this market. We are at fib extensions in the E-mini S&P, the SPX, and most of the indexes, which tells me that we are extremely stretched. We're up 9 out of 10 days, well up over 6%, straight up, basically vertical. And a lot of the indexes are moving, not so much stocks, but a lot of these indexes like the S&P, for instance, the Dow Jones, and the index really that we follow. So a word of caution here is that we are logically due for a pullback, and we can get a pullback at any given time. And as I'm speaking to you and recording this in an early morning session, we're down about 10 handles in the E-mini S&P for this morning. And there is plenty of room to the downside, so please just keep that in mind. I want to go right into the indicators, and I'm not going to show you much, but I do want to show you some important key indicators here. Prior to that, I want to show you this. This I got from Zero Hedge. Excellent analogy of what he's really putting at. That should the markets really be up here at these levels, and we all know that it's based on the Fed accommodating and pumping money into the market here and inflating the market up. But if you look at here, the green line is the S&P, and this is just a great analogy I wanted to share with everybody. The green line is the S&P. Here's crude oil. Here's the current EPS flat. Here's S&P. HY credit. S&P. GPD estimates 2013 down, lower, up. We're up with this. U.S. macro down. And you get what I'm saying. Copper, Dr. Copper, which follows, which actually leads the market. Excuse me, not follows, but leads the market, is lower. Did nothing for 2013, where the market actually excelled. 10-year yield, U.S. dollar index lower. And this is what the Fed is doing by pumping money and extending QEs, destroying the dollar, which is going to create additional inflation here. Federal Reserve balance sheet. Okay, so this is something that is so true. This is not just estimate. This is so true what's going on here, and this is not anything pretty if this market starts to excel to the downside. Now, I'm not saying that it will. I'm not saying that we're going to get a market crash at all, but I'm just saying that eventually this is not sustainable. The charts do look great, but they are way overextended. When you get the monthly charts overextended and in a grossly overbought state, you have to be very, very careful. The market could actually turn on a dime, and that's why I said I would be definitely looking to buy puts for protection if you're swing trading. Okay, so anyway, enough of that. Let's get right back to it. New highs, new lows, up at these areas. And what happens when we get up these areas? We get a market pullback anywhere into the 500. But we're at here at 823, guys. This is really a good sign that, hey, I think we're a little bit overextended. Stocks above the 50-day moving average, 87th percentile. This is where the logical spot for a market pullback. Okay, let's take a look at the McClellan Oscillator. Back into overbought territory. Now, again, we all know that overbought is not a sell signal, but it's definitely a concern that you'd want to at least be tighten up stops, trail stops, because we're making fib extensions in the market. The VIX. VIX did not sell off where this market rolled over. Why? Because people are getting cautious. Well, maybe select a few. So the VIX actually stayed where it was, right around the 12.5, 13 area. And so people are starting to buy some put protection. And now, lastly, is the U.S. dollar. Now, the dollar has been getting decimated for what's going on with the Fed, as you can see. So right now, all bets are off on the dollar as far as looking for a long trade with the currency pairs, only because we are obviously clearly in a downtrend. We have bearish symmetry making lower lows and lower highs. As you can see, our moving averages are just all above the 8, the 20, the 50, and the 200. So I would not be looking to do anything long on the dollar until it stabilizes and starts to reverse here. As you can see, though, we're coming into some heavy support at $79. So, again, keep that in mind. But I would not be looking to buy the market at these levels. And as you can see here, we are at This is the 2012 November lows. And let me just stretch this out a little bit so you can see it better. We met our first target of 1272 fib extensions. We actually excelled it at 1754.50. That is the all-time new high for the E-mini S&P. And this green line, as you can see here, it says 875. This is where we're down right now in the pre-market session, 875. We're down as much as 12 handles, which is not really that much, but we're going to need to really stay. 1740 on a closing basis is really what we want to see in the E-mini S&P to negate the pressure to the upside. 1740, your first target will be 1720, and then of course the round lot number of 17. I would even like to see us get back to the 1676 and still be in an uptrend, guys. We would still be in an uptrend if we start to take out this pivotal low right here. This is the pivotal low that we're looking for, and that's the October 9th low. If we take that, then I'm going to be looking for a deeper downside correction in the E-mini S&P, okay? But if we stay well confined within this the first or the second trend line, which really the second trend line would actually just give us a double bottom on a test. But if we need to hold one of these two trend lines for a continuation of the rally. Otherwise, I think we get a deeper downside correction here. I don't think right now that was going to happen. But remember, markets, when the fundamentals are shown up in the charts first before fundamentals and news start to happen. Remember that. That is so true. All right, 1272 extension is met. Next extension would be 1781. But again, guys, I would literally just be very cautious here when you're in your trading and make sure we tighten up stops here on the way. Okay. USO. Now, USO is actually down another $1.07 today. So this is not reflected as the end of day for the crude oil, I apologize, is down $1.07, which 97 in crude is critical. And last sale is 97.22. So this is why I said I really didn't like this. We call that trade here with that big pop up, and then after that it just literally just died. And this is a nice head and shoulders pattern here, 3640, 3945, 3945 minus 3640 gives us a $3.10 move to the downside. Okay, so we're looking at 3640 minus 3.10 gives us a 3330 target area. Now, does it really have to happen? No, of course not. But this is where the target would be, right into this area here. And this is where our target spot for the head and shoulders. And I'm just going to do this right here, right around there. Okay, so this is the target for the S. Now, if in fact that it were to go in here, I would definitely be buying crude oil. But what I would do for a trade, and this is only for a trade, not to fall in love with crude, if we need to see what happens here, as of right now, if the market were to open this morning, crude would be below the 200-day moving average. So this is not something I'm looking to pick bottoms or tops, but in this case, a bottom, I would not be looking to buy crude at all here. I'd wait for it to stabilize above the 200, take out that base, and then for a trade, this is a counter trend trade. Now, remember, has a lot of work to do to get back to the upside. I would be looking to buy crude, but crude is getting more interesting by the day. I'd love to see USO get right into this area here, 33.5, 34. I look to probably average into oil for a December, January pop higher. Okay, so that's crude. Now, as I mentioned yesterday in gold, I said, watch, guys, be careful. And I stated my case why I think gold will go higher, showing you palladium, copper, and silver. And palladium was our leader. I had a big move yesterday and is actually moving higher. So that will follow suit with all of the other metals. And we are now above the 50-day moving average. I am not a buyer. I'm not advocating a buy here. I'm just saying if you wanted for a trade, you could have bought yesterday on that gap up, the 15-minute hold, and then you would have been off to the races. I'm a better seller of gold back into these areas, or a buyer of gold in the 1,000 to 1150 in the GC contract, okay? But right now, I'm just watching gold here, see if we can get a better short off. Again, it alleviated its downside pressure here, bearish symmetry of lower lows and lower highs. We broke that downtrend line, and that's why I said just be very careful here. We could get a big move to the upside, and we did. So I'm watching gold for a trade as well. Let's take a look at some of the indexes, and I just wanted to show you the monthly chart. When you're elevated at these levels, and you're extended with the momentum in the case, you have to use a word of caution. This is actually insane for what letting the government do what it's doing to these markets. It's actually terrible. This is not a healthy environment, because when the markets do crash, and I don't mean crash, but when the market actually sells off hard, there's a lot of longs, a lot of retail guys that are buying up in here, and it's going to be hurting their long-term account, and that's not fair to them, and that's why I say this is not healthy. An up move, 4%, down 1.5%, 2%, another up move 4%, maybe down 2%, stair step up is a good way of actually managing this market. Weekly chart, we just took this bearish rising wedge out ever so slightly, and we came back in here. Now remember, it's only Wednesday. We only had 2 trading days of the week, so this will revisit again at the end of the week. Here's the daily chart. As you can see here, we have this confluence area of resistance, right? We have this trend line, and then we have this long-term trend line from the November 2012 lows. So if we can actually start breaking down that, now, which we will, we are trading $1 lower in the spiders in the pre-market. So this will take out yesterday's low, and we're into Monday's low and Friday's low, and into these candles. So if we start taking this out, even look for the 8 as the first target of 170, 172, and then of course the 20, and then the 50, and then you get this fib cluster down here. So let's see where this market goes and if it has any additional legs here. And here's the diamond. Same thing with the diamonds. As you can see, we're actually holding this area here, but again, met this resistance of this November 2012 uptrend line. Again, look at the Bollinger Bands. We're at these standard deviations here. We're all at extended levels. And when you see these Bollinger Bands way up high here, you got to be concerned, especially 10 out of 9 days, or 9 out of 8 days up. It's, to me, it's a concern to me, because I look at it the fact that, you know what, this is not right. This shouldn't be right, and would only be taking some selective trades, and even day trading, guys. The markets are so jittery that you try to get a week short, and if where do you buy the stock? A gap up, and then the market moves for the first hour, and then just consolidates for the rest of the day. I mean, it's a hard thing to do in the last 8-9 days, unless you're coming in long and holding position. But then you have that overnight risk, which I'm not looking to do at this moment. Anyway. Bollinger Bands I don't have here, but we are way extended up here in the transports. Transports also our number one leader here, looking for a move, looking to relax a little bit. Now Goldman had a move here. We actually popped above 160, but we closed back below it. Now, obviously, if the market does sell off a little bit today, Goldman's going to sell off as well. But I still like Goldman holding this level here. A break below this 156, you got to get out, because you're going to be testing at least a 200-day moving average. But I'm still watching Goldman for a long trade. I do like that long. And here's the XLF, as you can see, way overextended. And it needs a little bit of a pause, a little consolidation, maybe a downtrend here to the 2056, and then move higher. Here's Apple. Apple came out with their product development meeting. Nothing new, nothing really big on Apple. I'd be looking to take profits here if you are long from our 494 call, and of course the 504 call. Look to take profits. See if we get back down to that 491-ish area. I don't think Apple has anything really exciting out. That's just me. I'm looking at it, and I do agree that I actually hear that there's a lot of people that agree with me, a lot of other tech-savvy guys. There's really not much going on at the moment with Apple, and it rallied going into that product meeting. So again, buy the rumors, sell the news. I'd be getting out right now. And lastly is the Qs, as you can see here. Again, up at extended levels of these Bollinger Bands, and at 20-day highs. All of these sectors are at 20-day highs, guys. So again, a word of caution if you're long. If you're long, great. Tighten up stops. I'd be looking to buy protection. Protection is cheap. If we get a down day today, they're going to spike the premium up. So I would be definitely making your decision today on that. Otherwise, be safe out there. Be selective in your trading, and let's see where we get the next pullback. I think the next pullback, if we get a decent pullback, at least for a trade, we could start buying some of the markets that have actually were suppressed, or at least pulled back a little bit. And also, you got to take note, a lot of the higher flyer stocks, Netflix, clear reversal, up $35, down $30. Google actually had a big move, as you know, on Friday, actually started reversing. Facebook reversing. So a lot of these gem names are now succumbing to profit taking. You have to realize that, and you have to say there's a reason for it. Now, the key question is, does the money go into another sector? So if we have sector rotation where money's going out of one going into another, that's fine. But if you have money coming out and going into bonds, going into treasuries, going into anything that's a safe haven, you got to be careful because that's when they pull the rug out of the market. All right, so be safe out there, and we'll speak to you tomorrow. Take care, everybody.